Hello everyone, my name is John Locke and I'd like to welcome you to The Winning Trade. But first, the required disclaimer material. This presentation is given for educational purposes only. We're not broker-dealers or financial advisors, and we're not making any specific trade recommendations. Also, please be aware that your risk in trading options is substantial, and please make sure you are aware of all your risks prior to placing any trades. Also note that in this presentation, we are using hypothetical computer simulated trades. They are believed to be as accurately represented as possible, but keep in mind that live results can vary from simulated results for many, many different reasons. If this is your first experience with us, my name is John Locke, and I'm a trading performance coach and mentor with Locking Your Success LLC, where myself and my team are here to help you win in life and in the market as well. I'm here to guide you today into the realm of high probability income trading. Now, in a moment, we're going to be going over the winning trade, but before I do, let me take a moment to tell you what we mean by an income or high probability trading strategy. An income strategy is where we put ourselves in the position to generate profits through the passage of time rather than solely depending on the price movement to go in the right direction. What this means is that we can often make money whether the price goes up, down, or sideways. Now, this doesn't mean we're going to win all the time, but it does mean that we have a much better probability of winning than we would otherwise. Now, when you find that you want more information as you're following along, simply contact us at lockinyoursuccess.com. That's L-O-C-K-E, inyoursuccess.com, or ask questions in the comments on this video below, and we can direct you to where you can find more information. The winning trade we're looking at today is called the X4 version 14. It's one of the 3 trades in our X4 trading strategy program, and we're going to call it V14 for short. This is a very simple, very conservative broken wing butterfly style strategy that we trade on the SPX. The position lasts for about 60 days and requires a minimum capital of $2,250. For the example size we're going to be using today, we're going to do what we call a 10 lot or 10 butterflies. And those 10 butterflies are going to have a planned capital of $22,500. As for risk management, the version 14 has a high profit target of 11.1% of planned capital. And if certain things happen during the trade, we will reduce that profit target to as low as 6.7%. The exit loss trigger is going to be 11.1% of planned capital. In this particular trade, if you do the math, that equates to a profit target of $2,500, a reduced profit target of $1,500, and an exit loss trigger of $2,500. So let's take a look at the position. Okay, so here is our example position. The X4 version 14 starts 77 days before expiration. So we're going to be looking at our June expiration cycle on this presentation. And our June cycle, our June monthly cycle on the SPX, now it's showing I'm using the PM options. That's perfectly fine. It doesn't really matter if you use the PM or AM, except if you're going to run it into expiration. This trade, we do not run into expiration. So I accidentally did this. I put this in the PM expiration, although either is fine. So we're going to start 77 days to expiration, and that gives us a date of April 3rd, 2020. This trade is exited when our August companion month is what we call it, or the August monthly expiration, or we can call it the August SPX PM expiration, is 77 days to expiration. So the trade could last approximately 60 days if we were to take it to full term. Once the August trade is due to be entered, this trade is going to be exited regardless of the condition that it happens to be in. So with this strategy, what we do is we enter a 60-40 broken wing butterfly, and by that I mean that we have a 60-point wing on this side. So we have short strikes, in this case at 24.40, we go 60 points down, and our long strike is going to be at 23.80 in this case. And then we have a 40-point upper wing. So if our shorts are at 24.40, our upper wing is going to be at 24.80. Now, when we enter this trade, we enter it so that the upper wing or the long strikes for the upper wing are approximately at the asset price. So right now the asset price is at 24.75. 24.80 is our closest strike to that, and if we're using 10-point strikes, which is what I prefer. So I come in at 24.80, I go down 40 points, sell my shorts, I go down 60 points, buy my longs. Now that is going to give us a certain delta number. So let me take out this put here. Now, depending on the conditions or the market conditions, the delta of a 60/40 broken wing butterfly, when you enter it at the long strike, sometimes it's positive delta, sometimes it's negative delta, sometimes it's flat delta. And that's all going to depend on the implied volatility situation that's going on. Right now, or as of last April, we had a very high implied volatility in what we call very flat implied volatility skew curves. That gives us a lot of delta when we enter. In this case, it was positive 13.78. The maximum delta I can carry on this position in entry, according to our guidelines, is positive 9. So what I'm going to do is I'm going to come in and I'm going to bring this down under positive 9. And here I bought a 5 delta put, and that purchase of that put brings our delta number down to positive 8.50. And this is what our entry position looks like. So for those of you who might be new, what I showed you over here, this is called the matrix. We have our expiration cycle across the top. So this expires June 19th, 2020. We are 77 days to expiration. We are actually in the PM options, meaning they settle on Friday PM rather than Friday morning. And down here on the left is going to be the asset price. This is the mid price of the option, the implied volatility of the option, and the delta of the option. So this was our entry. This was the put we bought. This is our expiration line. So the dark blue line here is that looks like a triangle is going to be the value of this position at any given price on expiration if we were to do nothing and hold it to expiration. This thin line that turns from red to light blue to green is going to be called the T+0 line, and that represents the value or the estimated value of the position at any price point as of today. So right now, the asset price goes along the bottom. Right now, the asset's at 24,775. We just entered the position, so we're at about zero profit and loss minus commissions essentially. And as time goes on, this blue line or this thin blue line or the T+0 line tends to migrate towards our expiration line. And if nothing happens, we make money. If the market goes up, we make money. If the market goes down, we make money, as long as we're above this level over time. And there is an adjustment procedure if the market goes down to help mitigate or prevent losses to the downside. So as of right now, this is what our entry looks like. Now, this was not a terribly exciting trade, which is what we like. In other words, if we can put a trade on and stay in it for 60 days and don't have to do anything and make money, then that's all the better, right? So but let me just go through a few dates here, and I'll just kind of click this ahead so that you can see how the position matures as we go along. So let's just go to the following trading day. What happened the following day is we immediately got an up move, and here we got an up move of 148 points, which is very, very big in the SPX. And as a result, we were positive delta. We didn't make as much money as we thought because the implied volatility didn't do what the model projected, but we did get a good gain here. We're up $1,459 in one day. Now, had the price gone the opposite direction, 148 points, we would have been okay also. So let's see, we started here. Had we gone down 140-ish points, we would have ended up here, and we would have been estimated to have been down $1,200. Now that probably would have been less than that, because had we got to move that size to the downside, usually the put protection kicks in. And something called implied volatility increases the value of this put more than the analytical software thinks. And a lot of times you'll end up actually up money when that happens. So let's just move this forward a few days here. And you can see we're doing well. We're up about $1,800 by April 8th. I'm going to shift this ahead to the 15th, one more week. During that time, I believe this was our entry date. we've essentially just been traveling up, and no need to fight the market here because the way we're positioned on entry, everything is fine. We're currently up $2,000 by April 15th. I believe that's only about 12 days, and our profit target is 25. So let's see how long it takes to get there. Or perhaps the market backs down, we'll see. Okay, this is just one of those runaway markets that runs up like crazy. And we're up 2,200 by April 20th. Let's go ahead another week. By the 27th, we're out of it. So let's go back to exit date. So this was our exit date. It was April 24th. So we were in the position from the 3rd to the 24th, 21 days. And we ended up taking our slightly over our profit target because we wait till the end of the day to decide whether or not to enter or exit the trade. And we're now up $2,626. So that was a fantastic trade. Since we hit our profit target, we're going to close it. And notice we haven't even entered our July yet. Since that was such a simple trade, why don't we take a look at another month? And so let's just go ahead and we'll shoot up into our July entry. So if I move this forward, this is what our July entry looks like. Very, very similar to the June, right? So we have the asset is at 28.29. That means we put our long strikes at 28.30. We go down 40 points for our 40-point wing. Throw our short strikes at 27.90. Go down 60 points for our 60-point wing. And by our 27.30s, you'll find if you look at that in isolation, the delta is too high. So we're going to come in here, add, in this case, -5 delta, or just enough to bring us down to, or subtract 5 delta, I should say, and bring us down to just under 9, and this is our entry position. And pretty much the same thing happened here. If we go forward, just say 2 or 3 weeks, there were no adjustments in the position. This one did receive a little bit more down pressure during the trade, but only to draw it down maybe $300, nowhere near our maximum loss of $2,500. And then if we continue to move forward here, this is what the position looked like on June 3rd, which is only how many days? Let's look at our T-log. Basically, this was another one. We entered, we exited. So we entered on May 1st. We exited on June 3rd. There were no adjustments required. We hit our profit target of over $2,500. We hit 26.25.49 by the end of the day. And that is another winning trade. And it's not even time to enter our following trade yet, which is August. That's entered in 2 days. Now, so the question becomes, not necessarily how did this trade do, but how has the trade done for the year? How did it handle that incredibly big down move? And how did it handle the move before that, which was kind of an uptrending, grinding type of a move? So let me pull down the results for this trade for the year. Now, these are results that we share on Options Trading for Income. We rotate this trade into the trades that we track Monday morning on our Options Trading for Income webinars. And this is the results that we've gotten so far this year. We've had an incredible 5 winning trades, 5 profit target winning trades in a row. It's not unusual to get 5 winning trades in a row, but it is a little bit unusual to get 5 profit target winning trades in a row. So this has been doing fantastic in this market, absolutely fantastic in this market. Yeah, even that big down move we got in August, which came actually right after entry, wasn't a problem, and ended up closing that trade out already at 11.14%. Earlier on in the grinding markets, when we had a really weird implied volatility skew, we were running about 3.6% during January and February. We had a very minor loss in March when in the March expiration cycle when the market really went down hard. But once that big down move was underway, it was all systems go, and we've been having fantastic results for the rest of the year. In fact, a trade for trade year-to-date return is 60.26%. Now we do have overlapping trades in this strategy. We don't always overlap all the time, as I just showed you, but if you do adjust for account overlap or leaving money aside to be in two full-size trades at once, that if you want to adjust for that, that runs at about 30.13% for the year when we've had just a crazy, crazy volatile market. And that is the X4 version 14, this episode's winning trade. If you like what you see, I encourage you to join us and discover how you too can follow along with this and many other great strategies as they unfold during our weekly Options Trading for Income webinars, and where you can also learn about our upcoming winning trade presentations and our trading success blueprint. And perhaps best of all, you can get information on our free Trading Performance podcast, where you can learn to become a much better and more effective trader regardless of the type of trading you do. And please remember to subscribe and comment on our YouTube channel, where I will personally answer any questions you may have. Thank you, and we'll see you on the next winning trade.